Okay, I think the audio must be clear now. Let me see if the audio is actually clear. Okay, I think the audio must be clear now. Let me see if the audio is okay. It's all clear. So we'll start. So common stock are called as in India it is called as equity shares. Preferred stock in India it is called as preference shares. Warrants, as you know, it is called as warrants, share warrants, and commercial papers, bills, certificate of deposits. All these are short-term securities. All these are short-term securities. Nothing big, nothing small. Okay, nothing big, nothing complex. All these are short-term securities. So what are pooled investment vehicles? So mutual funds, investors can purchase shares from the fund itself. So most of the people make mistake in this. Open fund are actually not open. Open fund means those securities just like private placement. So it has very few people have access to these. But if it is a closed ended fund, it is a secondary market, and these mutual funds can be freely exchanged and traded over the securities exchange. So ETFs, ETNs, exchange traded funds, and these are closed-ended funds but have special provisions. Exchange traded notes, exchange traded funds, equity traded funds, equity traded notes. So conversion into individual portfolio securities, sometimes referred to as depositories, and the shares as DRs. Okay, so these actually trade like closed-ended funds but have special provisions allowing conversion into individual portfolio securities, which means that these can be converted into individual portfolio securities, and these are sometimes referred to as, what are these referred to as? Sometimes these are referred to as depository receipts. Cool. So backed securities. What are asset backed securities? Uh, backed securities represent a claim of a portion of pool of mortgages, car loans, car debt, etc. Cool. Represent a claim to a portion of mortgages low. So whatever securities a company issues, there is a backing by way of an underlying asset. It may be car loans, it can be mortgages, it can be home loans. Some asset is backed for the securities the company is issuing. So hedge funds, these are limited liability partnerships. Investors, limited partners. Fund manager is general partner. This thing we'll study it in derivatives chapter. So mutual funds like structure for HNIs, they use leverage, hold long and short positions, use derivatives, and invest in illiquid assets. So currencies, so these are issued by government, central bank. Yes. Okay. So investors, limited partners, fund managers, general partner, mutual fund like structure for HNIs. So uh, hedge funds use leverage, hold long and short positions, use derivatives, and invest in illiquid assets. Huge use derivatives and invest in illiquid assets. So currencies, these are issued by government, central bank, and reserve currencies. So currencies held by governments and central banks worldwide primarily includes dollar and euro. So currencies, one is issued by government, central bank, the other is reserve currencies. Currencies held by government and central banks worldwide primarily includes dollar and euro. So these are held as forex reserves. So contracts, yes. So we learned about the types of investment vehicles. We learned about types of securities. We learned about markets. We learned about assets. Now we learned about currencies. We learn about contracts. So what is forward contract? It is an agreement to buy or sell at a predetermined price in the future, and something that is contracted at its inception date. So agreement to buy 200 lbs of wheat 60 days from now for $800. So we are we are actually getting into an agreement to buy or sell at a future date, but at a predetermined price. So future contracts, it is very much similar to forward contracts, but it is this happens on exchange traded, and forward contracts can be for anything. These are unregulated, do not happen over exchange market, but futures, very few limited securities come into futures, maybe equities, debt oriented securities, um, and very few others. But forwards can be anything. It can be agriculture produce, it can be gold, it can be agriculture produce, it can be gold, it can be anything. No idea what is happening. Okay, cool. And agreements to and swap contracts. What are swap contracts? These are agreements to exchange a series of payments on periodic settlement dates. Agreements to exchange a series of payments on periodic settlement dates. So currency swap or equity swap, loan in one currency for loan of another currency, and exchange of return on equity index for interest payment on debt. Return on equity index, fine. So insurance contracts used to hedge against unfavorable or unexpected events. So life insurance, PNC insurance, etc. Okay. Uh, okay. Uh, Credit default swaps are form of issuance that makes a payment if an issuer defaults on its bond. Credit default swaps are a form of insurance that makes payment if a issuer defaults on its bond. Okay. So commodities, they trade in spot, forward, or futures market. Include precious metals, metals, agriculture products, energy products, um, credits for carbon reduction. Include precious metals, metals, agriculture products, energy products, um, credits for carbon reduction. Okay, it's good. And real estate. Real estate include real estate, equipment, machinery, and assets. Real assets. These are real physical assets. So buying real assets directly often provides income, tax advantages, and diversification benefits. This is very important and can be asked in the examination. We need to rush a little. So heterogeneous in nature. So they require to do substantial due diligence before investing. So heterogeneous in nature. So what are this? So what are these? These are heterogeneous in nature. They require to do substantial due diligence before investing. So rather than buying real assets directly, an investor can make investment in REITs, real estate Real estate investment trust. You can write it down somewhere. Real estate investment trust. So these are high dividend payout and tax advantage, or master limited partnership, or buy the stock of firms that have large ownership of real assets. Okay, cool. So we learned about real estate, we had learned about commodities. Now we'll learn about types of financial intermediaries and their services. So we have brokers, exchanges, and alternative trading systems connect buyers and sellers of the same security at the same location time. So dealers match buyers and sellers of the same security at different points in time. Arbitrators connect buyers and sellers of the same security at the same time but in different venues. So brokers, securities. So this See, brokers, exchanges connect buyers and sellers of the same security at the same location and time. May not be exchanges of the same security at the same location and time. I don't agree with this. So dealers match buyers and sellers of the same security at different points in time. Dealers, yes, different points in time. Dealers for different time. So arbitrators connect buyers and sellers of the same security at the same venue but at the same time but in different venues. Arbitrators, different venue but same time. So securitizers and depository institutions package assets into a diversified pool and sell interests in it. So insurance companies manage the risk inherent in providing risk. Providing risk. Clearing houses reduce counterparty risk and promote market integrity. Manage risk that is inherent in providing insurance, and clearing houses reduce counterparty risk and promote market integrity. So block brokers, placement of large trades, and ETS do not reveal current client orders as dark pool. No regulatory function. Placement of large trades. So block brokers, placement of large trades, and ATS do not reveal current client orders as dark pool, also known as ECNs and MTFs. No regulatory function. So we have learned about different types of financial intermediaries and their services. Okay. So positions and short positions. Positions an investor can take in an asset. Long position in the means long position. If an investor is taking a long position, it means that the investor has confidence on that asset in the long run. So long benefits when the asset value increases. Short position, it means that the investor has entered into an agreement to sell or deliver an asset or results from borrowing an asset and selling it. Short benefits when the asset value decreases. Leveraged position, when an investor buys a security by borrowing from a broker, the investor is set to buy on margin and has leveraged position. When an investor buys a security by borrowing from a broker, the investor is set to buy on margin and has a leverage position. So, investor buys a security from by borrowing from a broker. The investor is set to buy a margin and has a leverage position. Okay, this one looks interesting. So leverage positions, leverage ratio. rate of return on margin transaction and margin call price. So how do you calculate leverage ratio? SO is spot price today 100 and S1 is spot price tomorrow, which is 120, and initial margin is 40%, maintenance margin is 20%, leverage ratio is 1 divided by IM, 1 divided by 40%, 1 divided by 40% is uh hello, hello, I have no. Leverage ratio is 1 divided by IM, initial margin, or opening price divided by equity is how much? 1 divided by 0.04, 100 divided by 40, 2.5. It's nothing but 1 divided by maintenance margin is leverage ratio. So rate of return on margin security S1 minus, so future price minus current price divided by equity price. Future price and current price divided by equity price. And margin call is equal to is current price into 1 minus initial margin 40% divided by 1 divided minus maintenance margin. All these are formulas and they need to be properly learned. Cool. We learned how to calculate leverage ratios, how to use equity ratios, how to calculate margin call price. So execution validity clearing instructions. So execution validity and clearing instructions. What is a bid price? Price at which dealer buys a security. Ask price. So bid price is a price at which dealer buys a security. BID. Dealer sells a security. Bidding. Bidding always happens when someone wants to buy. Bidding to buy. Okay, buy, buys a security. Ask price is when a person wants to sell the security. Cool. So bidding is for buy, asking is for sell. And the traders who post bids and offers are said to make a market. Those who trade with them at posted price are said to take the market. Cool. Are said to take the market. So bid price, traders who post bids and offers are said to make market, and traders, those who trade with them at posted price, are said to take the market. So somebody who posts the bids is the person who is making the market, but someone who will trade at those prices, who will trade at those posted prices, are said to take the market. So market order is what? It instructs the broker to execute the trade immediately at the best possible price. And appropriate when the trader wants to execute quickly at unfavorable prices. Market order, it instructs the broker to execute the trade immediately at the best possible price. Appropriate when the trader wants to execute quickly. and limit order, avoid price execution uncertainty, order might not be fulfilled. Okay, bid ask, aggressively priced, taking the market, making the market, making a market, behind the market. If it is 51.5, there is nobody who wants to buy at 51.5. 51, he is taking the market. He wants to sell at 51. He's just taking the market. But he wants to 50. It's a new market. 51. There is 52, 53 also. So this is taking the market. What is it? This is taking the market. So what is 50? 50 is making a new market. And making market behind the market. Perfect. Making market behind the market. Perfect. Limit orders waiting to execute are called standing limit orders, and limit buy order with price considerably lower than the bid price, or a limit sell order with a price significantly higher than the bid is said to be far from the market. Limit buy order with a price considerably lower than the best bid, or a limit sell with a price significantly higher than the best ask is said to be far from the market. Nobody wants to sell at such a price, and nobody wants to buy at such a price, then it is far from the market. So yeah, all all or nothing orders execute only if the whole order can be filled. All or nothing orders execute only if the whole order can be filled. Hidden orders, only the broker or exchange knows the trade size. Iceberg orders, some of the trade is visible to the market but the rest is not. Okay, what is it? Execute only if the whole order can be filled. Execute only if the whole order can be filled, only when the broker or exchange knows the trade size. Broker, exchange knows. Iceberg order, some of the trade is visible to the market. It is not. Validity instructions specify when an order should be executed. Day orders, they expire if fulfilled by the end of the trading day. Good till cancel, they last until they are filled. They actually specify when an order should be executed. They actually specify when an order should be executed. They expire if unfilled by the end of the trading day. Till they are filled, cancelled unless they can be filled immediately. They are only filled at the end of the trading day. So what is validity? Specify when an order should be executed. So when an order should be executed, and day orders, they expire if unfilled by the end of the trading day. Good till cancelled, they last until they are filled, and immediate or cancel, they are cancelled unless they can be filled immediately. So intraday, good till cancelled, last until they are filled. Immediate or cancel, fill or kill, they are cancelled unless they can be filled immediately. What are these? They are cancelled unless they can be filled immediately. Immediately is the word. So good on close, they are only filled at the end of the trading day. If they are market orders, they are referred to as market on close orders. They are only filled at the end of the trading day. Only at the end of the trading day. If they are market orders, they are referred to as market on close orders. Stop, trigger, below the current market price executed on a downside only. Stop trigger, above the market price. Order placed to protect short position. Placed to protect short position. Stop loss by order. Selling can happen, but buying cannot happen at that rate. So clearing instructions tells the trader how to clear and how to settle a trade. Retail trade settled by broker, institutional trade settled by a custodian or another broker. How to clear and settle a trade, broker, custodian. So primary and secondary markets. So primary markets, it is for newly issued shares currently trading, not yet traded, are currently trading in the market, is called as secondary issues. And then IPOs issued by, which are not currently publicly traded. So secondary markets are of after their initial issuance. Book building process of gathering indications of interest. Indications of interest who agree to be part of the issue. Book building process. Gathering indications of interest who agree to be part of the issue. Underwritten offering. Investment bank agrees to purchase the entire issue at a price that is negotiated between the issuer and the bank. It must buy the unsold portion of the issue. So investment bank agrees to purchase the entire issue of at a price that is negotiated between the issuer and the bank. It agrees to purchase the entire issue at a price that is negotiated between the issuer and the bank. It must buy the unsold portion of the issue. Crazy. So best efforts offering. So investment bank makes best efforts to sell the issue, but it is not obliged to buy the unsold portion. Best efforts offering, not obliged. IPOs are typically underpriced because investment banks have a conflict of interest with the issuer. As issuers agents, investment banks should set high price to raise the most of the funds for the issuer, but as underwriters, they prefer to set price low to sell the whole issue. Oversubscribed IPO is referred to as hot issue. Oversubscribed is called as hot issue. Please, man, please. So, private placement securities are sold directly to qualified investors, substantial wealth, and investment knowledge. Self registration firm makes its public disclosures as in regular offering, but then issues register securities over time when it needs capital. Private placement is when it issues directly to institutional qualified investors. So private placement is when securities are issued directly to qualified investors and self-registration. A firm makes its public disclosures as in a regular offering, but then issues the registered securities over time when it needs capital. Yeah, it is already, but then it issues only when it needs capital. So dividend reinvestment plan allows existing shareholders to use their dividends to buy new shares from the firm at a discount. So rights offering, existing shareholders are given the right to buy new shares at a discount. Because of rights offering, shareholders ownership is diluted because unless they exercise the rights. So existing shareholders are given the right to buy new shares at a discount because of rights offering is diluted unless they exercise their rights. So existing shareholders are given the right to buy new shares at a discount because of rights offering is diluted unless they exercise their rights. So okay, cool. We'll continue. Can we continue? Okay. Uh, this is done. Then importance of secondary market. So what is the importance of secondary market? They provide liquidity, they provide price value information. Better the secondary market, easier to raise capital in the primary market. Cool. Better the secondary market, easier it is for firms to raise capital in the primary market. So code-driven, order-driven, brokered markets. So call market securities are only traded at specific times. So they are liquid when in session but illiquid between sessions. So used in smaller markets, but it is also used to get set opening prices on major exchanges. Continuous are traded at any time when the market is open. Price is set either by auction or by dealer bid ask quotes. So code driven traders transact with dealers who post bid and ask prices. Code driven these are all very important. So dealer maintain inventory of securities are also known as dealer markets. Over the counter markets, more securities other than stocks trade in this markets. Order driven or executed using trading rules, matching rules, exchange. Oh, okay, brokered. Brokers find the counterparty to execute a trade. So useful when the trader has unique or illiquid security. So dealers do not carry inventory of these assets. So brokers find the counterparty to execute the trade. So brokers find the counterparty to execute the trade. Useful when the trader has unique or illiquid security, example artwork, large blocks of stock, etc. Dealers do not carry inventory of these assets. Do not carry of these assets. So order matching rules. Order matching rules. So order preference hierarchy determines when which order goes first. The first rule is since priority is price priority. So secondary precedence rules determine how to rank orders at the same price. So first order order precedence hierarchy determines which order goes first. The first rule is price priority. So which order goes first? So secondary precedence rules determines how to rank orders at the same price. Okay, this is quite important. And trade price rule, after the orders are matched, trading system then uses its trade pricing rule to determine uniform pricing rule, discriminatory pricing rule, and then derivatives pricing rule, crossing networks where they match buyers and sellers who are willing to trade for prices obtained from other markets. So pre-trade transparent investors obtain pre-trade information regarding quotes and orders, obtain post-trade information regarding completed trade prices and sizes, and dealers prefer opaque markets. Transaction costs and bid ask spreads are larger in opaque markets. Well functioning financial systems, characteristics of a well functioning financial system. So, complete markets. So, savers receive a return, borrowers can obtain capital, hedgers can manage risk, and traders can obtain needed assets. Operational efficiency, trading costs are low. Informational efficiency, prices reflect fundamental information quickly. Allocational efficiency, in informationally efficient markets, capital is directed towards most productive use. So, characteristics of a well functioning financial system are complete markets, yes, return, borrowers, hedgers, all these things. Trading costs are low, operational informational efficiency, reflect fundamental information quickly. Allocational efficiency, in informationally efficient markets, capital is directed towards most productive use. In informationally efficient markets, capital is directed towards its most productive use. And market regulation, objectives of market regulation: protect unsophisticated investors. Objectives, what are the objectives of market regulation? So what are the objectives of market regulations? Protect unsophisticated investors, establish minimum standards of competency, help investors to evaluate performance, prevent insiders from exploiting other investors, promote common financial reporting requirements so that information gathering is less expensive, require minimum levels of capital so that the market participants can honor their commitments and be more careful about the risk. This is all simple. Cool. So, three times more to go. Security market index indices. So, what is a security market index? Used to represent the performance of an asset class, security market, or a segment of a market, is a hypothetical portfolio. What is it? This is nothing but a hypothetical portfolio. This is used to represent the performance of an asset class, security market, or a segment of a market. So price and total return. So price return and total return. Price index uses only the prices of constituent securities. Total return uses both price and income of the constituent securities. Rate of return that is based on return is based on price return. Rate of return that is based on price index is referred to as price return. Rate of return, it is return. I think this is total return, price return. I think so. This is total return, price return, total return. Only the prices, price return, price and the income of the constituent securities. So one is the price, the other is the income. Income also of the constituent securities. One is the price, and the second is the income also of the constituent securities. So the choices and issues in index construction and management. The target market, the index will measure the securities to be included from the target market. Appropriate weighing method. Choices and issues in index construction and management. So the target market, the index will measure. So the target market, the index will measure securities to be included from the target market, appropriate weighing method, how frequently to rebalance the index to the target weights, how frequently to re-examine the selection and weighing of the securities. One is you have to see which is the target market, and then you have to see the securities to be included in the target market, and you have to take the appropriate weighing method, and then you have to take what uh, how frequently you have to rebalance the index to its target weights, and then how frequently to re-examine the selection and weighing of the securities. Cool. So index construction, different weighing methods used in index construction. So you have price weighted, you have equal weighted, you have market capitalization weighted, you have fundamental weighted. Different weighing methods used in index construction. So price weighted, it is what? Average price, percentage change. Equal weighted, percentage change, average price. Market capitalization weighted, market capital percentage change. Fundamental weighted, users weights based on firms fundamentals such as earnings, dividends or cash flow, can be based on single measure or a combination of measures. Can be based on a single measure or a combination of measures. So different weighing methods used in index construction. One is price method, average price into percentage change. Equal weighted, percentage change, average price. Market capitalization, market capital percentage change. Uses weights based on firms fundamentals such as earnings, dividends or cash flow, and can be based on a single measure or a combination of measures. So these index returns can be both price return or total return. So these returns can either be price return or total return. Fundamental weighted uses weights based on firms fundamentals such as earnings, dividends or cash flow, can be based on a single measure or a combination of measures. And these can be based on a single measure or a combination of measures. Secondary precedence rules determine how to rank orders at the. Cool. Okay, next is what? So index weighting, price and total return. So they have given us constituent securities A, B, C, D, and we have P0, we have P1, we have DPS, what is dividend per share, we have quantity, we have percentage change in price, we have percentage change in price with dividend per share, and then we have market cap, we have market cap 1, and then we have dividend. So price weighted is what? Take the total of P1 divided by percentage change divided by 130. So it's 137 minus 100 divided by 130, right? Total return, you also have to take both price and income as the constraints, the major constraints. You have to consider the price as well as the income. So yeah, so here what you have to do, so first you have to take, so what you have to take, the first what you have to take is the price. So when you if you're calculating price return, price is a major thing, price is the only thing. But if you are calculating total return, then you have to consider price variable as well as the other income constraints. So 137 is the price, and then you have to take other constants, which is dividend per share, to calculate price weighted. sorry, yeah, the total return divided by the change divided by the p0. Okay, equal weighted price return is how much? Average of percentage change in price. So let's calculate this. I'll go get my calculator. For example, we'll use it here. I have to use it. So what is this? 137.5 divided by 130 minus 1, 0.577, and percentage change, average of percentage change in price. So 130, so it is what? 137, sorry, 137.5 minus 130 divided by 130. How? Why? Percentage of average price. What is average price? Percentage of average price. So 140 plus equal weighted. How did they calculate it? Equal weighted. Each equal number of, okay. Into number of shares also we have to take it, is it? Equal amount of shares. Let me calculate this once. So it is percentage change in price. So how do you calculate this? 10,000 into 140 store 1 recall 1. Okay, so and then it is 20,000 into 80 store 2, and it is 5,000 into 154 store 3, and it is 15,000 into 176 store 4, store 4 ಆಯ್ತಲ್ಲ, and then it is 100 into store 5, 120 into 20,000 store 6, and 140 into 5,000 store 7, 160 into 15,000 store 8. So recall 1 plus recall 2 plus recall 3 plus recall 4 store 1 0 recall 1 0. Okay, recall 1 and recall 5 plus recall 6 plus recall 7 plus recall 8 store 2 recall 1 plus recall 2 recall 1. Okay, recall 1 plus recall 2 store 1 store 1 divided by recall 5 plus recall 6 recall 7 plus recall 8 plus recall 9. Equal weighted is how did they calculate this equal weighted? A price return of 6.667 average of total price equal weighted. So equal weighted, check once market cap is price return minus 16410 divided by plus minus 1 market cap. This is the market cap one. Oh, they have only calculated here 40% average, just the average price market cap. But ideally we should have got it below 137.5 minus 130 divided by 130. 40 minus 33.33 plus 10 plus 10 divided by 4, 6.66666. Okay. And then we have equal number of shares in each constituent stocks, and then what do we have? Equal number of shares in each constituent stocks, market cap index minus proportion of market. In price weighted index, denominator must be adjusted for stock splits. Keep this in mind. Shit. Free float. Okay. Rebalancing or reconstitution of index. So adjusting weights of securities in portfolio to their target weights after weights are changed due to changes in price, usually done quarterly. Due to changes in price, weights, change in weights. Okay. So adding or deleting of securities that are included in an index, the price of security added to an index increases and the price of security deleted from an index decreases. So what are the uses of market indexes? So uses of market indexes are reflection of market sentiment. You have benchmark of manager performance. You have measure of market return. You have measure of beta and excess return. You have model portfolio of index funds. So what are the types of equity indexes? You have broad market index. You have multi-market index. You have multi-market index with fundamental weighting. You have sector index, and then you have style index. Model portfolio of index funds. So what are the types of equity indexes? You have broad market index, you have multi-market index, you have multi-market index with fundamental weighting. You have sector index, and then you have style index. ठीक है ओके. Types. What are the types of equity indexes? We have broad market index, usually contains a large component of market's total value. Multi-market index. It is used to measure the equity returns of geographic location. Uses market capitalization weighted for securities within a country's market, but weight with global market, and then measures returns for a sector. Measures value or growth strategies higher constituent turnover than broad market indexes. So we have broad market, we have multi-market, we have multi-market index with fundamental weighting, we have sector index, we have style index. So what are the types of fixed income indices? So fixed income indices can be classified by issuer collateral coupon, maturity default risk, and inflation premium protection. Issuer collateral coupon, maturity default, and inflation protection. So fixed income security universe is much broader than the equity universe. So it can be classified by issuer, it can be classified by collateral, it can be classified by coupon, it can be classified by maturity, it can be classified by default risk and inflation protection. Fixed income security. Fixed income security is much broader than the equity universe. Since fixed income security is mature, they must be replaced in fixed income indexes. As a result, fixed income indices have a higher turnover. What is it? Since fixed income securities are mature, they must be replaced in fixed income indexes. As a result, fixed income have higher turnover. Fixed income securities are primarily traded by dealers, so index providers have to depend on dealers for recent prices. So these are dependent by traders, and then these actually, so that's the way these work. So yeah, that's the way these work. So that's the way these work. Cool. मजा आया भाई, मजा आया. After a very long time, I felt very good. Okay, cool. They must be replaced by fixed income indexes as they have a higher turnover. So once they mature, they must be replaced. And the fixed income securities are primarily traded by dealers, so index providers have to depend on dealers for recent prices. So fixed income securities are primarily traded by dealers, so index providers have to depend on dealers for recent price. So indexes for alternative investments. So indices representing alternative investments. So commodity indexes are there, real estate indexes are there, and hedge fund indexes are there. So commodity, real estate, hedge fund. So commodity indexes based on commodity futures, not spot prices. So these are based on commodity futures and not spot prices. Real estate can be based on appraisals of property REITs, hedge funds, equally weighted indices. Okay, means valuation. They provide smoothing effect as a result in lower standard deviations. Some indices can be hedonic, which means constructing indices after adjusting for quality. Types of security market indices are: we have geographic location, we have sector, industry, we have level of economic development, we have fundamental factors. So market efficiency, the concept of market efficiency and related concepts. So informationally efficient capital market. All information available about a security is reflected fully, quickly, and rationally in its current price. So, 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 so. So, informationally efficient capital market, all information available about a security is reflected fully, rationally, quickly in its current price. In a perfectly efficient market, investors should use passive investment strategy because active investment will underperform due to transaction costs and management fees. So, market's efficiency can be determined by the time taken for information to reflect the price in the security. Market prices are not affected by the release of information that is well anticipated, only new information that is unexpected changes. In the price in efficient markets, market value is same as intrinsic value, thus expected return would be equal to required return. So in efficient markets, market value is same as intrinsic value, thus expected return would be equal to required return. In efficient markets, market value is same as intrinsic value, thus expected return would be same as required return. So market value versus intrinsic value. So current price of the asset is called as market price. So what is intrinsic price? So current price of the asset and can be known with certainty, value that a rational investor would be willing to pay. Can't be known with certainty, changes constantly as new becomes available. So what is market value? Which is current price of the asset, can be known with certainty, and intrinsic value, value that a rational investor would be willing to pay, can't be known with certainty, changes constantly as new information becomes available. Factors that affect market efficiency. Participants, more the market participants, more efficient the market. And availability, more information available to investors, more efficient the market. Limit arbitrage activity and allow some price inefficiencies to persist. Short selling improves market efficiency. Restrictions on reduce the market efficiency transaction will be inefficient. Cool. So forms of market efficiency. Weak form, price and volume. It is preferred fundamental analysis in the side of trading. Technical analysis. Semi-strong form, passive portfolio management, price and volume, public information. Insider trading, technical analysis, fundamental analysis. So strong form, passive portfolio management, price and volume, public info, private information, nothing. Technical analysis, fundamental analysis, insider trading. Weak form, semi-strong form, so market and other pricing anomalies. Something that deviates from the efficient market hypothesis. We have time series data, cross-sectional data, calendar anomalies, January effect or turn of the year effect. First 5 days of January are significantly higher than the rest of the year. Reasons: tag selling and window dressing. Why? It is because of tag selling and window dressing. Overreaction anomalies. let's continue. And then we have overreaction anomalies, we have momentum anomalies, we have side effect, we have value effect, time series, January effect. So what this says is, in January, anomalies are more. So the kind of anomalies we see are related to tax loss selling and window dressing. Overreaction anomalies, firms with poor stock returns over previous five have better subsequent returns, while a weak form of market efficiency because profitable strategy is based only on market data. Momentum anomalies, high short term are followed by high continued high returns, while a weak form of market efficiency because profitable strategy is based only on market data. Small cap stocks outperform large cap stocks because information is publicly available. Okay, crazy. And so, according to research, stock returns are related to known economic fundamentals such as dividend yields, but relationship between them is not consistent over all the periods. So, behavioral finance examines the actual decision making processes of the investors. So, overview of equity securities. Oh my god, exactly what that was. Securities, the characteristics of types of equity securities: common type equity, capital appreciation, variable dividend, function of probability, voting system, statutory voting, cumulative voting. Preference shares, both stock and debt, not mature, have call or put, voting rights, fixed dividend, function of probability, second preference in case of liquidity and dividend payment. So, based on accumulation of dividend, cumulative, non cumulative dividends that are not paid, past must be paid. Dividends do not accumulate over time. Participating receive extra dividends if firm profits exceed a specific. Not participating can be converted to common stock, cannot be converted to common stock. So, ownership characteristics among different equity classes. So, ownership characteristics among different equity classes. Some companies' equity shares are divided into different Class A and Class B. Different classes of common equity may have different voting rights and priority in liquidation. They may also be treated with different dividends, stock splits, etc. Such information can be found in company filings with securities regulators. So, private equity compared to private. So, private equity compared to private equity. Public equity issued to institutional investors. So, private equity is issued to institutional investors. So, this one has to be kept in mind. So, this is issued to institutional investors. This is less liquidity. This is direct negotiation between firm and the investors. And then we have limited financial disclosure. We have lower reporting costs. We have potentially weaker corporate governance, and then we have greater ability to focus on long-term prospects. We have potentially greater return, VCs, LPOs, NPOs, PIP, venture capitalists. Okay, 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 cool. Okay, peace. Yeah. What are the methods for investing in foreign equity securities? Integrated markets, capital flows freely across borders, and then investment are denominated in foreign currency, maybe liquid, less strict regulations. Depository represent ownership in foreign firm traded in markets of other countries in local market currencies. So bank deposits shares of the foreign firm, then issues receipts representing ownership of foreign shares. If a firm is involved with this issue, it is sponsored year, unsponsored year, voting rights. Bank has voting rights. If it is a sponsored year, if it is a sponsored year, then the equity shareholder or the investor has voting rights. If it is unsponsored, then the bank has voting rights. So what is depository receipts? So what is depository receipts? So these represent ownership in a foreign firm traded in the markets of other countries in local market currencies. The bank deposits shares of the foreign firm and then issues receipts representing ownership of foreign shares. If the firm is involved with the issue, it is sponsored DR or it is an unsponsored DR. Okay. Global depository outside of US and outside of the uh, and outside the issuer's home currency. Global are traded in different currencies on stock exchanges around the world. Is an ETF that is a collection of depository receipts. So American depository receipts. Level 1 is over the counter. Level 2 is NYSE, NASDAQ, Amex. Level 3 Amex. 4 is private. SEC registration is needed. Yes, private is not needed. Okay, next, why difference? So okay, risk and return characteristics of equity securities. So returns consist of dividends, capital gains, losses from changes in share prices, foreign exchange gains, if any. So common measure of risk of for equity securities is standard deviation. Putable shares least risky, callable shares most risky. Cumulative, non-cumulative, less risky, lower dividend yield. So role of equity securities in the financing of companies' assets. Used for long-term assets and then by other companies, employees, publicly traded. Equity and company value. Market value is what share enterprise reflects investors' expectations about timing, amount, risk of firm's future cash flows, assets minus liabilities. Return on equity, cost of equity, minimum rate of return that investors require. Dividend distribution model or CAPM, estimated return is more than required return, then invest. So forecasting is there, industry and competitive analysis. Okay, so what do we have here? We have forecasting, and revenue, profitability, capital projections, identify key risks and uncertainties, industry and competitive analysis, define industry and trends axis. So it provides what? It provides a framework for understanding the firm. So what are the uses of uh, industry analysis? It provides a framework for understanding the firm and can provide information about firm's competition, growth, the risk, the debt levels, and credit risk. Okay, it means overweighing or underweighing the industries based on current phases of business cycle. And performance attribution analysis, the sources of portfolio return are determined relative to a benchmark. So ways to group companies and industry classification systems. Firms can be grouped into industries according to their product, services, business cycle, sensitivity or thorough statistical methods such as cluster analysis, group of similar industries. Global industry classification standard S&P, MSCI, para Russell global sectors industry classification. So international standard commercial classification identifies the constituent firms, updated frequently, includes for-profit and public firms, do not MSCI bar is 4 tier, Russell Global is 3 tier, ICB Dow Jones is 4 tier. Cyclical firms are what? Are highly dependent on business cycle, have high operating leverage, often expensive or non-necessities whose purchase can be delayed until the economy improves. Energy, financial technology, and non-cyclical firms earnings are less dependent on business cycle, can be further separated into defensive, stable, or growth industries. Defensive uh, demand is strong, largely affected and affected. Crazy. Survey steps estimate size and growth, measure industry size using total annual sales from product customer perspective, calculate growth rate, calculate YOY growth or compounded annual growth rate, consider volume and price mix, breakdown growth contributions from volume and price mix drivers, handling private companies. So what is this? Handling private companies, industry size may include private companies estimate using economic indicator surveys, issuer data, corroborate. Style box approach characterize growth using a style box. Compare the broader economic growth. PESEL, politics, economics, environment, social, legal, technological, competitive, personal, intentional, and intentional strategy, planned, measured, aligned, capital company wide. access against industry forces, vessel influences, and resource capabilities. Valuation is unique to each company and industry. Three competitive strategies are cost leadership, differentiation, focus, and desirable situation for a company. Clarity and strategy is clue. Oh my god. Cool. So we have successfully finished equities to some extent. Starts on 39. Okay, okay, cool. Time to sleep. Seriously, time to sleep. Take care. Good night. We'll see you tomorrow.